covering quite a lot in this next 60 minutes. I know Sam is going to bid us farewell, so I will just let her go for the time being. And then any questions, I've got the chat open just in case I can kind of see them as we're going. So first and foremost, we're going to look at some kind of key terms. Now, I've said in the London market, but as I was going through the book, I was thinking, actually, I need to flag here essentially where it's different from LM1. So I've pulled out some various terms, so they kind of come across all areas of the book. Some of them are quite heavily situated in chapter 2, which is an area that's quite hefty, but we'll get through some of those bits today. Then I'm going to look at some key points in reinsurance. So everybody gets a little bit nervous. If you're not in reinsurance, sometimes people get nervous about reinsurance generally. Just the terminology behind it. So we're going to look at what sits behind all of those aspects, and that's all of chapter 3 that I'm going to kind of put into a bit of a nutshell and give you a bit of guidance on. Then we're going to look at the general rules of broking, underwriting and claims handling. And then penultimately, I think we'll go across to delegated authority. Now, you'll be pleased to know there's far less, although it does get mentioned somewhat, there is less legislation to be familiar with in this particular book. And there is fewer kind of regulations as well, because you did all of that stuff in LM1, so it simply just builds on that particular area. So there'll be a couple of things that you do notice today from LM1, and that's great, because I'm assuming that most of you will probably have done LM1 pre-COVID. So it's probably in the back of your mind at the moment, and the back of your memory. The only other last bit that I just want to flag is I've just called it extra stuff, where it maybe doesn't sit in the headlines of what we're looking at, but I just thought I would mention it as well. So there will be a few other aspects of that too. So I'm just going to get on with the rest of the content. So here are my kind of key terms that I just wanted to flag. Some of you might have met these already if you've looked at the book already. First and foremost, we have, when we're talking about the first chapter, they discuss the market. They discuss why it's appealing to lots of international businesses to actually get insurance from the London market. And they go through all the standard terms that you've met already in LM1. So they talk about Lloyd's as the marketplace and the society of members. They discuss companies. They talk a little bit about proprietary companies, those owned by their shareholders, and mutual companies, those owned by their policyholders. And then they discuss a little bit in terms of, they discuss through essentially what needs to happen in terms of a mutual indemnity association, which is a P&I club, protection and indemnity. Sorry, I'm trying to do two things at once, meeting a few people that are coming in still. So do forgive me if I'm trying to talk and click. So the only other aspect that you might not have mentioned or seen already is something called a Lloyd's service company. Now, these are quite unique. They come up a lot in delegated authority. So what they are is they're authorised essentially to introduce business into Lloyd's, but they don't come under that Lloyd's banner. So they're a separate company, but they work very closely with syndicates. And essentially what they look at doing is making sure that the syndicates are getting good access to other areas of business. So I refer to them as a sister company because they work so closely. So it's S for service company, S for sister, and S for syndicate. So hopefully that will draw it into your mind as to how that kind of fits. But we'll talk more about those when we get to delegated authority. Now, let's look a little bit at RITC. Some of you might remember what this actually stands for. You did look at it very briefly in LM1, but just to give you an overview, we have reinsurance to close. Now, some of you might remember, a syndicate at Lloyd's typically keeps their books open. So they'll have their year of account for 12 months, and then they'll keep their books open for another 24 months. And the reason that they do this is because they want to make sure that claims that have happened in that particular year of account have essentially come to fruition, maybe been settled, even if it takes a couple of more months than they expected to actually get that all completed. However, unfortunately, liability business and casualty business is quite long-winded. When I used to be a claims adjuster, I ended up looking after some files that I swear were older than me at the time. So they were kind of relics of the claims industry, and they've just been sitting around not settled for a very long time. You kind of have to blow the dust off of the claim file when it was a physical claim file. And so the reinsurance to close aspect is whereby, so you've got your 12 months, then plus the 24 months that you keep the actual book open. And that's to make sure if you do have any outstanding liabilities on that particular book, the syndicate really wants to know whether it's made money or not from that particular year of account. So what they'll do after that 3-year period, they'll say, right, let's close off our books. And what we'll do is, if we've got outstanding claims that still haven't been paid, we'll reinsure them into our next year of account. So that's why we call it reinsurance to close. And sometimes it will be a separate company that takes this liability on, but sometimes they'll just do it into the next year of account. And so you end up finding those long tail claims are no longer kind of an issue. And then you can decide whether that particular year has made a profit or a loss. So where are we now? 2020. So at the moment we'll be looking at our 2017 kind of year of account. Then it would have been open from 18 to 19. And if any of you guys remember, that's the year we had all those terrible hurricanes, so not a best year for insurance. But essentially, we were looking at whether we've made a profit from that 3 years down the line from the inception of that very first year, or that year of account. So that's reinsurance to close. In the middle, before I get to these little 4 kind of words on the other side of the screen, I just want to flag a couple of areas that the book is different from LM1. I didn't include this in my rundown, the classes of business, purely because it's quite a nice area just to kind of read through. It's nothing too crazy in there. I will just flag a couple of areas that are new, so that you didn't meet them in chapter 3 of LM1. So chapter 2 discusses everything in a bit more detail. We have, among those on the screen, which I'll go through, so we have agricultural crop damage, which is also in, so it's in LM2 rather than in LM1. They mention it very briefly, but it's not really explained until LM2. So they're looking at kind of any disease or any reasons why crops haven't yielded that particular year. So that is any damage on that basis. My little kind of Bank of England thing there is what we call financial guarantee. Now, if any of you remember LM1, you remember that you cannot insure something that's speculative. This is on the brink of being speculative. You're essentially trying to get insurance for change of exchange rates or change of property values or change in interest rates. And Lloyd's really doesn't like this area of business. You have to get permission to actually write it, and you have to make sure that you're fully aware of the risks involved. So we call it financial guarantee, not to be confused with fidelity guarantee, which you did meet in LM1, which, if you remember, is to do with employees kind of dipping their hand in the till and essentially kind of siphoning off money from company accounts and things like that. So dishonesty in employees. And then my final one that I just want to mention, but I will flag a couple more just as before we go on. This is directors. So typically D&O, directors and officers insurance. What we have insurance for here is a very specialised version of professional indemnity insurance against individual directors, because they are liable for their actions as a director of a company for all the decisions they make, making sure that they're not negligently running the company, making sure that they've done everything in their capacity to keep their employees safe. So essentially, that's a number of things that they need to take into consideration. Welcome if you're just joining us. We're just going through one of the first kind of content slides. So crop, financial guarantee, directors and officers. Another few ones are cyber insurance, drone insurance. That's slightly different from the LM1 book. There's also bond risks and a few others about contract frustration and trade credit and various other areas that they're just kind of snuck in to this particular chapter. So what I would say is try not to be complacent. When you're reading through this book, don't kind of go, oh, you know what, I've done this already in LM1, I know this. Read through it still, piece by piece, because there will be some extra detail in there that will be kind of significant. So just make sure that you're aware of those. And on this point, so this is still kind of remaining on chapter 2 at the moment, We have a couple of terms, and just by talking to a few people who've done their LM2 in kind of recent times, so a little bit pre-COVID and a little bit recently as well, because as Sam said, people are starting to do their exams again now. We have a couple of words that tend to come up quite a lot in things like the case studies that are in this particular book. So we have jettison. This is a very old concept. So we have Roman law talking about jettison, the principle of jettison. It's basically where a ship is unstable, you're throwing things over the edge into the sea to make it balance out or float a little bit better, I guess. So the peril of jettison tends to be the damage that's caused when you actually physically throw the thing over the edge. So if you're jettisoning something, that's what it is. Barratry is essentially whereby the master and the crew potentially turn on the owner of the boat. So they kind of gang up against them, maybe to steal the boat or get cargo, even though it's pirates in Captain Phillips. I always think of Captain Phillips when I think of this. And essentially they're trying to get hold of whatever they need on that boat or take control of it. So that is also a peril that's covered under the marine insurance. Now, collision liability, I will flag as well, because a standard hull policy, so for the actual vessel itself, it doesn't have 100% of the risk. So it's only insured for what we call 3/4, so 75% of the risk is insured. And so we have to go and source that further 25%, maybe from places like protection and indemnity clubs. So the P&I clubs will maybe take over that ship owner's liability of 25%. The reason I'm flagging this, again, in some of the little mathsy questions in the case studies, nothing to be worried about. But they might say, for example, a vessel is insured for £2 million, and how much would the whole policy pay out in this instance? It would be 1.5, because it would be 75% of that 2 million. And then very finally, just to flag it as well, we have this concept of general average, whereby it's quite a nice one, this one. If somebody has made a sacrifice to save somebody else in dire straits at sea, then essentially everybody else chips in to essentially reimburse them for their bravery. So this is a concept of general average, and make sure that they are awarded for their sacrifice. So these are quite old school principles, but ones that are still relevant in some of these concepts today. I'm going to move on, and we're going to go to reinsurance. So obviously I only got 60 minutes here, so I'm just conscious of the time, and I will keep an eye on that as we go. As I said, do feel free to put things in the chat, and I will stop for air at some point if you want to make notes. Equally, if I've said something and you've missed it and you want to complete your notes, just type into the chat and I'll just repeat it when I get to another section whereby I can have a quick look at the chat. So this is one of my favourite areas, the reinsurance side of this, purely because when you first look at it, you think, oh my goodness, this is crazy, I'm never going to get it. And then when you do get it, it's such a triumph that you actually end up liking it more than other parts of the book. And I promise you that will be the case when you actually get through this. So the first kind of key points that you've already met in terms of reinsurance in LM1 is this concept that we're always constantly trying to spread the risk further afield. So we're transferring the risk to different locations, different territories. We're transferring it to different parties, different insurers. So we're always on the lookout for ways to spread that risk. Reinsurance does this. It also gives insurers peace of mind. And I use this analogy with my group this morning as well. But if you think about capacity in LM1, it talks about capacity as being, how full a glass of water is. Essentially, capacity, you'll only have a certain amount. Once you get to that capacity, you're not able to write any more. So what reinsurance does is it allows you to kind of take some of that back, and then you've got capacity to write other areas, purely because reinsurance will take on some of that burden for you. It might reinsure 25% of all of your risks, and therefore you've got that further capacity to write further risks elsewhere. So that's peace of mind. It also evens out those peaks and troughs. So if you ever see a claims experience and there's a massive spike because somebody has died or there's a fatality on the book, insurance and reinsurance should act together, so whereby reinsurance is taking that cap and they're just smoothing out those peaks because they're taking anything above a certain amount. And I've already just mentioned, but releasing capacity is also one of the other